Is Mario here? He probably went back to sleep, y'all. So we might just have to
Yeah,
do
but
another. Huh?
yeah, what's about?
Oh, you woke back up?
I didn't sleep, man. I'm just listening.
I knew that I was different. I seen it, I thought it, I dreamt it, I said it, I did it, I made it, I taste it, I love it, I need it, I want it.
So you can find AV maps from they changed the positions. Hold up. Yep, right over here. So, and if you're using TradingView, there should be a tab called projections. So go over there and you'll find AV maps right over there under the volume based section. So just favorite it so you can have it right over there as a shortcut. When you first initially add the AV map, you should be getting something like this instead of the ones which you're seeing right now. It should be, you'll be getting like a bunch of shits like this. So just disable every single thing from the style. So you don't need to have any of these. Just have this one line alone, which is the VWAP for the particular day. The bands can be a bit confusing and the bands can be a bit cluttery to the charts, and you'll be having lines floating around in like every corner of your charts, which makes the analysis part a pain in the ass. And I mean, if you have like 100 lines in the chart, what are you even going to do with it? Like, you can't even trade with it. You can't do anything with it. Same with having like 3 4 indicators at the same time. Like, it doesn't tell you anything. It's gonna do you more harm than it's gonna do you more good. So just remove off the bands and just keep the charts clean. That way, like, you can analyze and make the plan better. So that might be helpful. I see a lot of questions like, which EMA lines do you guys have on your chart? Depends. I use different moving averages for different time frames. If I'm in daily, the one which I use is the 50-day and the 200. That's the only thing I keep an eye out for: 50-day, 220. So these three are the three moving averages which I keep an eye out for when I'm looking at the daily time frames. But when I'm switching over to smaller time frames, these things goes on unseen. So I don't want to see those in those charts because it's going to clutter it. So if I go to the 15, it's all 5-day moving average. I think I spoke about this in the previous sessions on how the 5-day moving averages are calculated. So I use 130 MA in the 15-minute chart, which is the 5-day moving average, and that's it. And I also have ATR, which tells me the expected price move for the particular day. So if I'm swing trading or if I'm day trading, this is all I need. This tells me everything I need to know. The 5-day moving average tells me the current trend and who's in control of the trend. AVWAP gives me the money flow. It tells me like whether the bulls or bears are in control of the money flow. So yeah, so these alone gives me what I need to know to take a trade with proper stop losses on. If you are a beginner, understanding VWAPs and understanding how to set proper stops alone will make a big difference rather than you adding like multiple moving averages and RSI, MACD, or I mean, if it works for you, that's good. But if you're just starting out, don't know anything about chart patterns, like don't know anything about candlesticks patterns or none of that, just learn about VWAPs and learn about how to set proper stop losses. That alone will be a massive step up. So once you get familiar with that, then these moving averages and everything just automatically comes in handy because the concept behind it stays the same. If you guys have any questions, let me know. So I'll give you an example on how to utilize VWAP. So this is today's session, by the way. This we are looking at the 15-minute chart. Let me go over to 1 minute. So I'll remove all the moving averages. Let me remove this as well. All right. So before the session opened, we had like two levels in mind. One is 441.20, sorry, 441.12-ish, and the other one is 440.25. In case of a pullback, in case of break under 442.78. So at the open, a lot of people were like, okay, I want to go short, but what point is an exactly right point to go short on, and where will you set your proper stop losses at? I mean, the price was just like hanging above the VWAP for the first 20 minutes of the session. So price was just like floating around over and over and never broke under the VWAP and nothing happened. But you did get your confirmation around two areas, one over here, but got immediately recaptured, and the one right over here around that 952, 953 area. So now they broke the VWAP, and let's say you take your entry right over here. Where will you put your stop losses at? Now your stop losses, this is where a lot of people, especially beginners, get it wrong because they enter at the right place. It's a perfect entry. The entry will be great, and their strike prices will be great, but they'll still manage to lose money because once they see a green candle in a 1 minute time frame, and once they see their contract went down like $10 or $20, they immediately panic sell, only to see that 100%, 200% in value in literally another 2-3 minutes. So when you're setting stops, always go for the recent lower high or higher lows. So let's say you take your entry on puts over here at around the break of 442.78. Your stop losses goes right over here, which is the recent highs at around 443.24. Or if you want a wider stop losses, it goes right over here, which is at around 443.80. If you're entering right over here at 442.70 and you're setting a stop loss at 443.80, you're technically risking $1. And let's say you buy a monthly expiration on SPY puts and you're shorting SPY and you're setting your stop losses at $1, you'll be losing, maximum you'll be losing will be $60 to $80 if you got at the money or in the money options. If this trade goes against you, you'll be losing $60 to $80. I'm talking about monthly expirations, by the way. This is the problem with the weekly or 0-day expiration, which you see in SPY. If the same move happened with the 0-day expiration, if the same move happened with the weekly expiration, you're going to lose like 60 to 70% of your contract. Everything which you put in, 60 to 70% are gone. While the monthly expirations only is going to let you lose $60 to $70. You see the difference? It's always better to lose less by buying monthly expirations rather than going for the 0-day today expiration and getting it wrong and then losing almost like everything. It's pretty simple. You see two things. You can see it as you can see it like this. While buying an option, you're putting in an investment. You're putting in a trade. That's your money. Whether you make it or lose it, that's all it is at the end of the day. With the 0-day today expiration, the probability of you losing it all is considerably higher compared to that of you buying a monthly expiration by spending a little bit more. You won't be losing it all. Even if you're wrong, you'll only be losing $80 even if you get stopped out with a monthly expiration of 442 puts. That's the maximum you can lose. So if you're a beginner, stop messing around with the 0-day today expiration or stop messing around with these weekly expirations. Give yourself time. It has a lot of advantages. Yes, it can be expensive. If you find it expensive, then it's not the right stock for you to trade. There are a lot of stocks out there like SoFi, Palantir, DraftKings, everything. These stocks offer you monthly expiration for way cheaper price compared to that of SPY. If you're beginners, it's not a necessity for you to trade SPY in the first place. So that being said, let's say like you entered right over here at 442.78, which was the area of pivot, and they broke under the VWAP, which also tells you the sellers took back control. And now you can set your stop loss at two areas, either at 443.70 or today's high is at around 443.25. Now, next question I can see is like, how can you set stop losses in options? The best thing to do is do it manually. If you're day trading, you will be looking at that position like a hawk every single minute. Every single candle, you will be looking at that position. So do it manually.
Back and forth.
Yep.
Because I do it. That's how I know.
Yeah, exactly, man. Because especially if you're swing trading. Yeah, if you're day trading or scalping, you should be looking at your positions because the time frame on your trade is no more than 2 or 3 minutes maximum. So if you just buy it, if you're at work and if you're day trading, if you're not looking at the chart, just don't trade when you're at work. Simple as that. So now your stop losses goes at 443.25, which is the recent lower high. And now they broke under. You can see what happened later. It went to your favor. Now, always buy multiple contracts. I'll tell you why. This might sound a risky statement to make, but that's the best thing to do. So buying multiple contracts gives you control of your positions. So let's say you buy a share of a company. Let's take a penny stock, or let's take any stock, all right? Let's say you buy one share and the stock price moves like 2%, and you sell that one share for, let's say, a small amount of profit. And once you sold it, you see the stock price going up 20%. And now you don't have any exposure onto the same equity. What's going to happen to your psychology then? You will be either looking for an area to chase it after the 20% move has already been completed, or you're going to get your entry at one of the worst places possible, and you're going to catch the top only to see it pull back all the way again because you are mad that you missed out or you sold early. So buying multiple contracts is equivalent to buying multiple shares. Let's say like you buy 3 contracts around here and you risk like almost 60 cents on this trade. The stock price moved all the way here. So what you can do is you can sell a few contracts. Hold up. You can sell a few contracts over here and leaving a few runners by moving this initial stop losses down towards this consistent lower high, which is at around 442.70. And the runners now will be like, if you get stopped out on the runners, you'll get stopped out for the break evens on the runners, but you're still getting out of the trade for profit. Let's say like the SPY just reversed from here and then start going up higher. But now you already since you secured half of the profits from some of the contracts, it's going to help you to manage the risk properly because you already covered your stop losses. It's a risk-free, emotionless trade. You only got few runners on the table. And even if you get stopped out on the runners, it doesn't matter because you already made some amount of money by selling those initial strike prices, which you already got. And now you can see it just completely melted down. And if you have multiple contracts, you can sell a few here and sell a few around here and sell a few around here, and you'll be done with it. That's what I did in the morning. This was my trade, which I took today morning. This was the thought process behind the same. It's pretty simple. Like there was no, you can see in my chart, this is how it looks like when I'm trading. No moving averages, nothing, just VWAPs, pure price action, and that's it. And proper stop losses setting. Because if you're a beginner trader, a lot of the things which I've, like most of the time, the one thing which I've seen over and over and over is people getting kind of panicky for every 1 minute candle which they see because you don't have a plan. That's why you're getting panicked. Because when you enter the trade, and okay, I get this mindset because I used to have the same mindset when I started out. I personally feel like as soon as I get into the trade, I wanted to start making money. Immediately, the second I get into the trade, I want the trade to go up like 20%, 30%, 40%. But God forbid that trade goes down like $5. I see you, Will. Because like God forbid that trade goes down like $5, $10 as soon as I enter. Hell breaks loose. You immediately get panicky because you didn't have a plan in the first place to begin with. You didn't have any place to set a proper stop losses on. Either you freeze and watch it go down like 60, 70% and lose it all, or you just sell it early because you didn't have any plan, only to see it either go in your favor or just triple in value. So if you are a beginner, the best thing for you to do at the moment is just focus on having a plan before entering the trade. What is a plan? Plan is nothing but, okay, this is why every time when someone says, I want to buy call on something, I always ask them, what's the plan? And one of the dumbest response which I get is like, oh, the plan is to make money. I mean, that's the plan for everyone. Like, no, that's not what I was asking. The plan goes something like this. You should know where you'll be taking your profits. You should know where will you be cutting the losses. And you should know how much you're risking with the stop losses, how much money you'll be losing with the stop losses, and you should be knowing how much money you'll be making if the trade goes in your favor. So all these things you should know even before pressing that buy button. Think about it. You're aware of all the scenarios. You're aware of how much you're going to lose. You're aware of how much you can potentially make. You're aware of where your stop loss is at, and you're aware of where your take profits at. Now you have a proper understanding on the trade which you're in prevents the panic thing from happening, because you exactly know how much you're going to lose if you're wrong. If you know that, the panic thing just goes away completely. And that's when you'll stop worrying about every green candle or every red candle in 1 minute time frame and starting to like, oh, I missed out on this move on this 1 minute candle. No one cares. No one cares. Like 1 minute, like you will see some wild shit in 1 minute time frames. Like that is not something for you to go on to take any trades whatsoever. Even in today's session, the 1 minute candles, you can clearly see my entry was around 944 today, by the way. I entered right over here on this candle. When they broke under the VWAP, I entered over here and I set my stop losses right over here. As soon as I place my entry, you can see what happened for the next two candles. This went up like crazy. And yep, now my stop losses did get hit. No, it didn't. So is there any reason for me to sell it right over here? Because like two candles in 1 minute time frames are up. Let me put things in perspective. Go to the 5 minute time frame and see the same thing. Check it out. Look at that VIX. They VIC'd you out. So most likely, if you just like panic sold this, you are just a victim of liquidity grab. They just like pushed higher. They made your stop losses hit, and then boom, back to square one. So I got my stop losses at 443.20, 443.73, which was, I'll be losing like almost $70, $80 if the trade goes against me, according to my strike prices. So, all right, fine, that's done. I know how much I'm going to lose. And now, if I'm risking like $1 on this trade, so I should be making at least $2 to $2.5 to the downside in order to make at least 3 times the profit. The beauty with options is the faster the move to the downside, the faster the premiums are going to appreciate in value. So even if like you thought the price wise, let's say like the $2 is going to make you $120 or $130 with the base of the risk which you have, accelerated moves like this are going to boost the IV of the underlying, the implied volatility of the underlying, which is going to make the option value go up like crazy in a small period of time. So that's going to give you the 3 times your stop losses and profits, and you can just exit immediately. The point of this is not to like talk about the trades which was winning, but the point is actually to tell you guys to have a plan, to have a proper stops. Your stops should always go at the recent higher lows or recent lower highs rather than just randomly setting it at 10%. What's the 10% has any significance to the market? The 10% is how much you can afford to lose. Market doesn't give a shit about how much you can afford to lose at the end of the day. You need to set your stop losses based on the market levels, not based on what you can afford to lose. If you can't set a proper stop losses, which I mean within your risk limit, well, don't take the trade. There are like millions of setup over there, and you can always go back over there and then take the trade over there, and don't have to force yourself in something by taking enormous amount of risks and then get stopped out only to lose like almost $300, $400, which will be like 10%, 20% of your portfolio, especially if you're having a smaller account. So now I spoke about the trade which made me money. Now I'll talk about the trade which lost me money, because it's always fun to talk about, oh, I made this much money, but nah, it's not always like cupcakes and rainbows.
That voice, so
That's a fact, though. That's you probably lose more than you win. Honestly, that's why the risk is important.
Yep.
The risk management.
So I got clowned by market pretty hard last Friday. So this is where I went long. So this was my, I think this was my entry on SPY. This was supposed to be a swing trade where like I just buy and I just like hold it for multiple weeks so that like I can capture a big move to the upside. So I got my entry right over here at around 448-ish when they broke about the VWAP on Thursday. And I set my stop losses at the lows of the day at 447.70. So this was monthly expiration, by the way. This was monthly expiration. I think I got October 21. That's the monthly expiration for October. Yeah, I got October 21st expirations, 449 calls. And I spent like almost $798 on this contract. And my stop losses were set at 447.72. By the end of the session, I was up like $82 and I was gassing myself up. I was like, fine, everything looked good. I'll tell you why. The 5-day moving average, you can see, was sloping up. The price, if I go to the daily time frame, and if I remove the 130 MA, and if I go to the daily time frame, you can see the price was above the 50-day moving average. They gapped above it. So everything was lining up for SPY to push towards this 453 to 457 levels based off on that Thursday close. So I took my chances over there. And then the Friday open happened. And then market gave me a big pie in the face with this shit. They gapped under the 50-day moving average. They gapped under the 5-day moving average, which you can see right over here. And yeah, my stop losses got hit. And guess how much I lost in that position? Almost $108. That was my loss because it's a monthly expiration. I still had a lot of intrinsic value and extrinsic value on the same. So the maximum I lost is $108. Let's say I just took a 2-day expiration on the same shit with 449 calls. What do you think would have happened when the price gapped down from 450 to 447 on that 0-day expiration?
Ain't no snapped.
Exactly. Exactly. Yeah, the same position, which was once up like almost 300% on that particular day, opened at -70. It's completely done over. So it's by trading these 0-day expirations or weekly expirations, you are literally just donating your money to charity.
Open the dice.
Yep.
Going.
You're literally donating your money to Wall Street. And especially if you're a beginner, I can see it all sounds tempting, like, oh, look at me, I made money with 0-day expiration. But nah, most of the time you'll be losing a lot of money. A lot of times you'll be losing, and it's not worth it, especially if you're a beginner. If you can't afford it, look for other setups. Like I think Will spoke about it. SQQQ. If you can't trade QQQ, SQQQ offers a cheaper alternative for the same thing.
Yep.
And if you want to short it, yeah, it's just
I made
$80.
my fault. Go ahead.
Go ahead, Bill. You're saying?
No, I was gonna say I made $180 off of 20 contracts, and
Yep.
it even cost me that. Well, how much I paid for them contracts? Like $9 per.
Yep. See, told you.
100%. Walked
It's a
out.
cheaper alternative.
Yep.
So same, if you want to buy calls on QQQ and if you can't afford it, look for TQQQ instead. TQQQ offers a cheaper alternative for QQQ. And there are a lot of ways to mitigate your risk. You don't have to trade SPY or QQQ. Like, oh, I can't afford monthly expiration, so I'm going for 0-day expiration. That's a terrible argument to have for not being able to afford something. Like, just because you're not being able to afford something doesn't mean you have to increase your risk. You have to be more picky in your trades, especially in your starting stages of your portfolio, especially if you're using a smaller portfolio. If you're not picky, you're going to get chewed up by the markets. You're not even going to get there. Go ahead.
Go ahead. But go ahead, but I want to say something at this point.
Yeah, go ahead. Sure.
When I started trading, people was doing 0-day, and they was doing big money play, and I couldn't do either because I couldn't keep up with the by the second, by the minute, come out a millionaire guys like them, and I couldn't afford the $500. I mean, yeah, $500 and up play. I couldn't play in that realm. So what I had to do was figure out, okay, this is the stock market. SPY, QQQ, and Tesla aren't the only plays that I have to play. So what I started doing was I went fishing, and I started looking for things related to those sympathies, if you will. Make sense?
Like, for example, when Nvidia is going up, you buy AMD. Got it. Yeah, that's the thing, man. Like, a lot of people, like, man, the beginners in particular start with the worst stock they can possibly, like trading SPY, which is one of the most competitive stocks out there. One of the most competitive stocks you can actually trade. If you're a beginner, start with shares. Why do you have to do options? Start with shares.
I did. I started with one share Tesla.
Yeah, I can see you having a good average on Tesla.
Yeah. and I never let go.
Yep.
See that?
Yep. Because like, that's the thing, man. Like there is a reason why 98% of day traders fail. They don't make money. 98% of day traders actually lose it because this is one of the most competitive industries out there. Because you are just like, do you know when you go for fishing, you put that small trap in the hook to catch the fish? That's what you are when it comes to stock market as
Little
a
fish,
retailer.
little big fish, so well.
Yep. That trap, you're even smaller than that. I'm not even being mean. This is just realism. It's just me being realistic. Anyone who's been in the markets for quite some time can tell you the same thing. So you got to know your place first if you're trading this. So you're going against billions and trillions of dollars worth of money. And the first thing that comes into your mind is let me trade options. No, it can sound good on paper, but options are made to be complicated for a reason. Because do you know the purpose of options? Can any one of you tell me the purpose of options? Don't tell me purpose for making money. I'm going to kick you out of the chat. Like, nah, it's like, what's the real purpose? Do any of you know like what's the purpose that the options are created in the first place? Anyone want to give it a go?
I'll take a stab if nobody. 'Cause I
Okay,
don't
go
know.
ahead, Bill. Share
I
your
don't know the
opinion.
answer, but I'm gonna speculate.
Mhm.
I feel like options are a contract that allow. I know by definition what they are, but I feel like that's what they're for. If that makes sense.
It's to
Mm,
buy a contract at a certain amount at a certain price, X amount of shares at a certain price.
Right. Right. If you look up
yes.
the definition of option and options trading, then that's what the baseline primarily thing is for. It just so happens that people benefit off of not having to own the shares. You have the money to buy the shares. You know, well, really, you would have made more money having the shares because if that option is going up, best believe the value of those shares are going up. And if you had 100 versus a contract, just saying, and you got in cheap, just saying.
Yeah, that makes sense. I mean, that's one way to put it. But the main reason why, I mean, I'm talking about when they actually created something called as options, right? So when it actually came out like a decade or two back, the main purpose of it is, let's say you're holding 100 shares in something, or let's say you're holding $1 billion position or $1 million position in a share. Options are a tool to mitigate the risk. And one of the users in the chat said to hedge. Exactly, that's the purpose of the options. If you're having 100 shares in the stock price, the options act as a tool to protect your portfolio from downside, because if you're buying shares, you are having unlimited upside potential because the shares can keep going up and up. There's no limit to how high a share can go. And you can't say like the price is too high, the price is too low. Nah, when you're buying shares, you're expecting the share price to go up. You're exposed to the upside. Now, what happens if something happens with the market and the stock goes down? You're going to be losing money. You don't have any protection to the downside. If the stock price starts falling like 10% or 20% or 30% after earnings, you will be caught with your pants down. There's because you don't have any protection to the downside. This is where the options come in. Options are the tool to protect your long-term positions. It's like insurance, which you pay for your car. You pay it every month. It doesn't mean you're going to get into an accident every month. But if you do get into an accident, it's going to come in handy. It's not going to burn a big hole in your pocket. That's the point of put options in the first place. Where like if you have 100 shares on SPY and the September is coming and you know that the September is technically a bearish month, what do? Let's say you have like 100 shares on SPY with $370 cost basis. It's just an assumption. So you got like 100 shares with $370 cost basis. And now the SPY, when the September opened, the SPY was currently at, let's assume, 450. So Now the SPY, your cost basis, the SPY went from 370 to 450 in a matter of few weeks or few months. Now the September is coming and you can see the pullback is on its way. So what you do is you just buy 2 months out, $450 put as a hedge. Now you can ask me like, oh, I'm spending like, okay, 100 shares at $370 is $37,000. And 2 months out, $450 put is gonna be worth not even more than $800. So you're ready to spend 37,000 on 100 shares of SPY, but not ready to spend $800 as a protection to the downside, especially into a seasonally more bearish month. Let's talk possibility here. Okay, let's say like this September was different. This September, the stock market just kept going up and up and up, and the SPY just went all the way towards 480 and made a new all-time highs. This $800 put is going to be expiring worthless, but you still have the 100 shares. That 100 shares is still going to be making you money and still going to be keeping your portfolio in the positive territory. But God forbid, like the markets just keep falling and SPY goes all the way to 400. The beauty of this 450 put is, let's say like by your expiration, SPY is at around 400. Now you have the right to sell your 100 shares, which you got at 370 at the strike price of your put by exercising it at $450 each. Because you got a $450 strike put as an hedge. And now the stock price is at 400, but it doesn't matter. Since you got the 450 strike puts, you have the right to exercise your 100 shares and sell your 100 shares, which you got at $370 at $450, which was the strike price of your hedge. This was the purpose of the options, to protect your long-term positions. And that's how you take advantage of it. And now I'm not saying there's no other way you can make money. This is the only way to make money, but understanding the purpose behind it, especially as a new trader, that helps a lot on how you take advantage of the same into your trading career as you move ahead. See options as a way of reducing the risk exposure rather than a way of like making some quick cash grab. Every time you try to make a quick buck, you're going to be losing more than you initially started with. That's how it always goes, especially as a beginner trader. Like you can talk to like 100 beginner traders who got lucky once or twice and who kept trading. They would have lost more than they've started with. 100%. And yes, 97%. Yes, the code goes. If it isn't hard, everyone would be doing it. Yeah, exactly. That's what I'm saying. When I say day trading doesn't work, what I mean is it doesn't work because most of the people either quit after their first big loss or won't take self-accountability or won't take responsibility for their shitty ass trades. And they just blame it on someone else or blame it on the markets, blame it on the hedge funds, blame it on everything else but themselves. And the 97%, that's how it starts with, because it's the human psychology behind. Because when you lose a lot of money in a matter of seconds, you'll be taken to some dark places which you wouldn't visit in your day-to-day lifetime. So that's going to make you reflect upon yourself as a person. It's going to reflect upon yourself on your mental health. You will learn a lot about your own self because you've been pushed into a place where you're not comfortable staying at. And it's going to make you either better or it's going to make you quit. And most of the people just quit because it's understandable though, isn't it? Because you lost a lot of money. You walked in, you thought that you'll be making a lot of money, and you just lost like your entire month's paycheck in a matter of seconds. What else you can do? Nothing. And you're like, nah, fuck it. Market is not for me. I'm done. So this is the first category. The second category is people putting their time learning and like learning technical analysis, learning like fundamental analysis and like doing all that shit, putting in hours and hours and hours of work and still lose money. This is like the second category. And this is like the worst. It is the worst because like, at least in the first, you know, like what's good for you and what's not. With the second one, it's always that hope. Okay, if I try this, it'll make better. If I try this, it'll make better. At the end of the day, if you think about it, you'll be repeating the same mistakes over and over and over again. Think about it. Like if you're a beginner who've been trading for 4 or 5 months right now, I can guarantee you every time you lost money, it always revolves around the same mistake. same or similar mistake. I've been there. I know how it goes. It can be like, okay, first, let's say you lost money today by going long on SPY, by buying calls on SPY. Okay, fine, you lost money and it didn't go up. It's all good in the morning. And then by the close, you see the SPY pushing all the way up from 440 and close exactly at where they opened at. And you look at it and you'll be like, oh shit, I missed out. I shouldn't have cut my losses. Nah, you were wrong. You cut your losses. And the problem is not you cutting your losses. The problem is you not re-entering back. It's a big difference. So you cut your losses too early or cut your profits too early, and you don't know how to manage your positions. You don't know how to scale up properly. You don't know how to scale down properly. This is the second category. Like, this is like, once you step out of that, I'm not going to quit, I'm going to keep pushing harder. This is the second issue which you'll face. Like, whatever it is, I'm not going to quit. So in that stage, the most common mistakes which you'll face is either cutting the losses too quick or cutting the profits too quick, letting the losses ride because you just completely freeze up when you see the stock just camping down and down and down because you didn't have an initial plan. And now you get into the third stage. After figuring this shit out, you get into the third stage, and that's when things start slowly getting better because you have a plan. You know how much you'll lose, you know how much you'll make. At this time, you'll be in the mindset that I don't care what the market is going to do because I don't have control over it. I don't know what the market is going to do. And even though I do technical analysis, even though I do fundamental analysis, it just gives me the probability of certain things working out, and it never gives me the certainty. I can never be 100% right on something which I don't know about. Simple as that. So that realization only steps in after years and years worth of experience when it comes to trading. So when you're learning technical analysis, get this in your head. Technical analysis doesn't predict what's going to happen in the future. That's not the point of technical analysis. If that's the case, everyone would be billionaires right now.
Yeah.
Everyone who can
That
draw
part.
two lines. Yeah,
That
exactly.
part.
Everyone who can draw two lines on chart will be billionaires. They are not, and that's for a reason. Because technical analysis doesn't predict the future. It just gives you the probability of some things working out in your favor. And trust me when I say this, I've seen folks who are really good at technical analysis, but still suck at trading. They still lose a lot of money because they don't know how to execute what they see in this charts. And that's a problem as well. So if you're new to the markets, get it in your head. Learning technical analysis doesn't mean you're going to be profitable. That's one. And number two, it might take you one step closer though, but that's not going to make you profitable. And there are millions of indicators out there. So when you go to any server, not just Chris Saint's server, anywhere which you learn, if you go there and ask them what's the best indicator to use, there is no best indicators. That's the answer. There is no best indicators. I use VWAPs. I use 5-day moving average. And I got the same 440, 441 zone. And if I go to Alvaro's tab, or if I go to Curtis, or if I go to Loudmind, and if I go to Spence or Av, they'll be using completely different analysis and they'll be coming up with the similar numbers. Ever wondered why? Yep. Because regardless of which indicators you use, you're going to be coming up with similar numbers or similar zones at the end of the day. So how you analyze the price doesn't matter. How you execute the same does. Where you set your stop losses does. So if you're new to the markets, get this in mind. Like, don't learn technical analysis in the mindset of like, oh, I'm going to make a lot of money. No, like everyone would have done it already if that's the case, right? Simple as that. What is the percentage of your wins? Okay, my percentage of my wins is 28 to 30%. That's it. And if I take 100 trades, I only win 28 to 30% of the time. But my P&L is still positive because every time I win, it's 3 times my stop losses. Let me give you an example. Let's take 100 trades, all right? This is what we call it position management and position sizing when it comes to markets, the technical term, right? Let's take 100 trade sample. So for every trade, you set your stop losses at $30. So when you enter a trade and if you lose $30, you get stopped out. But every time you win, you're setting your take profit at $90, which is 3 times your stop losses. All right. So for me, I just have a win rate of 28 to 30%. Let me just say 30%. So I only win in that 100 trades. I only win on 30 trades. I lost on 60, how much? 70 of the trades which I took, I lost. So let's calculate my total losses now, shall we? So $30 on every single trade, 70 trades losses, which means $2,100. I lost $2,100, but I only won 30 trades, but for every win, I made 90. Now that's 2,700. At the end of the day, I'm still turning up, let's say after commissions and stuff, I'm still turning up like $500 to $600 in profit. Win rate doesn't matter. Like ask any professional traders. If you go to Twitter, or if you go to Twitter and just search for CMT, you'll be seeing a lot of these traders who've been worked in the hedge funds or worked in the banks or worked in the trade desk. Ask them. And the one thing which you'll hear is win rate doesn't matter. How many times you win doesn't matter. And there's actually a study which I was talking to Spence yesterday. If you have a higher win rate, it's actually a bad for your portfolio compared to that of you having this 30% or 35% win rate. You can ask me now, like, how having a higher win rate is actually bad. Answer me honestly here. If someone tells you they have a win rate of 90%, will you believe them? Like someone just says, like, I
I
always
think probably
win.
maybe 68 to 70%, but not no
Yeah.
90 nothing.
Yeah, it's like if you are new to the markets, and if you see someone saying that I never miss, I never lose, I always win, like amateur behavior.
Yeah, I say that, but I show people have seen my losses.
Nah, you're like, nah, you
But I
troll.
joke around, but
Nah,
my
you troll, not you. Like I'm talking like people actually say this shit seriously.
yeah.
I know you troll a lot, like you troll by saying
Yeah,
that.
I'm definitely
I know, I understand the differences. Yeah. No, but in reality, when people say they have 90% win rate, one, it's not possible. And two, how do you think they get that win rate? They have wider stop losses.
I was
If you
just
never
about to
get
say,
stopped out, you never lose. If you never sell, you never lose, right? So what they
I just,
usually do, they just let the position go down like a lot, crazy lot, and keep averaging down over and over and over and over again until it yields profit. And one time it doesn't go up, they're toasted, done for, because they held on to that position, losing position for a long time because they don't want to affect their win rate. And that's going to take away months and years worth of profit in one single trade. And this research shows that everyone with a higher win rate have higher drawdowns. By drawdowns, I mean, like, I just gave you an example, because when you only have a higher win rate because you don't have your stop losses, you never get stopped out. So now when you lose in one trade, you're done for. Months of profit wiped out. Like you worked hard for your 3-4 months of your journey to keep your portfolio higher, only to lose it all in one trade and back to square one. So it's a pretty interesting research on the same thing. Ab, you're saying something?
Somebody was, but I don't want to interrupt them.
Yeah, so that's the thing. Like, don't focus too much on win rate. It doesn't matter how many times you win. No one cares.
I'm glad you went over this, because that's what people focus on so much in the damn group. I see they care about the damn freaking
Win
win
streak.
rates.
That's what they call it.
Yeah, they're winning streaks instead of how
Yeah,
much they're losing on the trade.
that's the thing, man. Win streak doesn't matter. Win streak doesn't matter. How many times you lose doesn't matter. Like, all it matters is how much you're losing versus how much you're winning. Every time you win, are you making at least 3 times your initial stop losses? If you do, there's nothing for you to worry about. Win rate doesn't matter. Ask anyone. I can bet you. I can bet you money. Go to Twitter, look for anyone with a CMT degree, chartered market technicians, or anyone who worked in the worked at the, what do you call it, the trade desk. Ask them. Even those algorithms in a high frequency trading doesn't have 100% or 90% or 80% win rate. What they have is good risk management. That's all they have. By risk management, I just gave you an example, the 100 trade example, which I just gave. That is risk management. Losing less, making more. Sounds good on paper, but that's how it is. Technical analysis won't make you money. And fundamental analysis won't make you money. Having a high win rate don't make you money. The only thing which is going to help you make money is understanding the basics of like risk management. 3 hours, making 3 times the profit or at least 2 times the profit. What's that?
Ryan Shannon seeing
Yep.
the alpha trends.
Yep.
All I had to see was the alpha trends.
Most of the things which I'm talking about is from his book, actually, from Shannon's book. So that's the thing, man. Like, focus on one thing, manage the risk. And if you're especially new, avoid the 0-day expiration, avoid the weekly expiration. And if you want to learn technical analysis, if you go to YouTube and just type technical analysis, look at how many videos you're going to find. Millions. And everyone will say this is the only way to make money. Every million of them will going to tell you like that's the only way to make money. But let's say you use like 13 EMA, 48 EMA, and what's the other one? 60, 65? Is that what you guys use? 13, 48, and the other ones which you guys use. Like, you can make money with that, and you can make money with just VWAP alone, and you can make money with no indicators. You can actually use any of this and come to the same conclusion. Come to the same exact conclusion which I came up with my own analysis. That's how it works. So instead of focusing too much on how to analyze the price, which EMAs is the best, and like which moving averages are the best, and there is nothing. The answer is nothing. There are like infinite numbers out there. What makes your 13 EMA the best out of that infinite numbers? I will just say, like, I have 14 EMA and my 14 EMA is better than your 13 EMA. Who's going to prove me wrong? No one. Because at the end of the day, as I said, I got 130 MA in my 15-minute chart, and I will sit here and argue that's the best moving average ever. And you can have the same 50-day moving average in your 15-minute chart, and you can argue that's the best thing you have ever. At the end of the day, both are going to give the same results. So it's a waste of time arguing about which is the best moving average or which is the best indicator, because there is none. There is none. So it's good to learn about them, though. It's good to learn about like how things work, why you see that squiggly line in your chart, which you see when you put EMA, and why price touches the particular moving average and then bounces. What makes that your moving average important compared to the other infinite numbers over there? Yep. Ask why. Always ask why.
And the chart is going to tell you a story. Like, you're never going to stop hearing people say that. So those indicators and all that stuff, that's the source, the chart. Those candles, or if you enter the lines, I don't know. But the candles or the lines, they're gonna tell you. The first thing you're gonna see is the price. When you look at a stock, you look at a number. Second thing you're gonna look at is the chart. So whether it be line or candle, like, you gotta know what you're looking at.
Exactly, man. Like, when you see this chart, all I see is people buying and selling. That's it. It's one of your orders comes into this thing which you see. When you buy and sell, this is how it looks like. And now, if you're making money, guess what? Someone else is losing it. If you're losing money, whatever money you lost is going into someone else's pockets. So with 0-day today expirations or 1-week expirations, if you're losing money, some moron in a BlackRock is selling those options to you, is getting filthy rich. Your brokerage is getting filthy rich on selling you those options. And they're just like selling you soy milk, and you guys are drinking it because it's like so easy to make money. At the end of the day, you're just losing it all.
That's why I always say thank you to the idiot that sold me this contract.
Exactly.
Because I bought it and I made money.
That's how it works, man.
That.
Yep. If you're making money, someone else is losing money. Simple as that. That's how the markets. It's not a nice place to be in. If you lost $10,000, you put that $10,000 into someone else's bank account. So that's why I say, like, think about, will you walk around the street with holding like thousands of dollars in cash and then just like put that thousands of dollars in cash in someone else's pocket? You won't, right? And now when you just look at your phone, why are you taking like decisions like that, rash decisions? Same mentality, same mindset. You wouldn't do it walking in the street. You would fuck them up if they take money from you. Yeah. Now when it comes to markets, it's a completely different scenario. You are like, okay, come here, I'll give you the money. You're going to take my money, take it, it's fine. That's what happens if you take decisions like that. That's why before you press the buy button, ask yourself over and over, what's the plan? Where's the stops? How much I'm going to lose if I'm wrong? How much I'm going to make if I'm right? And if I lose this much if I'm wrong, how much it's going to affect my portfolio? And if I lose that much in my portfolio, how much it's going to affect my overall performance for the year? You should know answers to everything before you press the buy button. And of course, you're going to get stopped out a lot. You're going to get stopped out a lot, especially if you're day trading. It's going to happen a lot. But knowing when to get stopped out, knowing when you're wrong and cutting it early, instead of just like freezing completely when the stock goes against you, helps a lot. So this is like the psychological aspects of trading. Simple as that. Like, it's technical analysis is easy. Learning technical analysis is easy. Let me tell you this. Mastering the psychology, not so much. This is the main reason why most of the traders fail. They learn technical analysis, they learn the support or resistance levels, they learn everything. They spent years and years worth of learning, but they seem to forget that the only thing which they should be learning about is about their own self, rather than learning about all these things, because it's not automated. You are the one who's pressing the buttons. You are the ones making the decisions, where to buy and where to sell. And if you're not psychologically strong enough, well, regardless of how good you are in technical analysis, you're still going to absolutely suck when it comes to trading, because you don't know what you're doing. You don't know what you're doing in the sense, like, mentally speaking, psychologically speaking, you're not strong enough. You're not self-aware of your mistakes. You're not self-aware of your strength. And the best traders, if you go and ask any professional traders, they will exactly tell you what types of markets they will trade. There are different types of markets, right? You must have heard about it if you're trading. There is trend trading, there is reversal trading, and some people will wait until like 1 p.m. in the afternoon and then trade the trend, continuation trend. So a lot of things are there. Different types of trading are there. If you ask me, I would say my strong suit is trend days. Those are the only types of trades where I would like to be involved with the markets. If I see chop, I don't trade. I just step away.
Yeah.
That's restraint, that's control. And how many times in the chat, in Chris Saint's chat in general, if you're a member over there, how many times you've seen over there someone just saying like, I'm done with the day, only like 5 minutes later saying that, oh, I took another one. 10 minutes later, I took another one. 15 minutes later, I took another one. Like, where's the control? In the long run, that's gonna have negative implications than doing you any good. If you trade futures, you'll exactly know what I mean, because futures, unlike the PDT rules or cash accounts, if you're using in Robinhood, it doesn't have any restrictions, by the way. None, zero. If you sell a contract in the futures, you'll get the money immediately in your buying power. And there's no PDT rules. You can trade like a million times a day if you want to. And that's why most of the beginners fail in futures trading, because like they don't know where to stop. They don't know when to walk away, because they just keep on trading over and over and over and over again, only to lose everything which they made and back to square one again, or lose even more. So I learned this restraint by fucking things up by futures trading. It took me like 6 to 7 months to just say fuck it and walk away. If I made money, $200, $300 a day, I'm done. That's it. I'm gonna either go watch some Netflix, or I'm gonna go for a run, or do anything else but looking at the screen and looking at the charts, which is gonna tempt me to buy another one.
Yeah.
I think Chris Sain himself shared something in the chat about the same thing. Put things into perspective. You just made your weekly paycheck in matter of seconds or matter of hours. And now you want more? Now that's great.
Yeah.
Now that is when things get messy. You work your ass off for every week to make the same 2,000 or 1,000 or 1,500, how much ever you make. You just made it in an hour. And now you go back and you're like, okay, I want more. And then you lose it all. I think people don't, especially new traders, don't understand the meaning of money when it comes to numbers. Since they're looking in the screen, they don't see it as they just see it as numbers, but not as money, which makes the value diminish in purpose, right? If they deal with cash, they're gonna. I can guarantee you they won't do the same mistakes they're doing with their Robinhood. I can guarantee you that. If I knock on your door and tell you that, okay, give me like $500 in cash to buy your put option in SPY, you will think like 3-4 times before handing me that money. But when it comes to the phone and numbers, fuck it, 500, who cares? And lose it all in a matter of seconds.
I did the same shit trading futures, man. I mean, I had made $400 in like 10 minutes and turned around and tried to make a trade again, lost it all real quick.
Yeah, I've been there, man. I know what you mean.
I never play futures, and it's like the more y'all tell me about it, I'm happy I've never played futures because I know me, I'll be right behind y'all sharing the same sentiment.
It's very addicting, man, playing futures.
And Forex too.
Exactly. If you think stock market is bad, man, you should try futures. That's like SPY on steroids.
It sure is, man. SPY on steroids, man.
Hey, Mario, what was the name of that book again? Someone didn't catch it, and I didn't catch it as well.
One?
Yeah, someone asked what was the name of the book that you was referring to.
Brian Shannon's?
I'm pretty sure, yeah, it was. Do you know the book that was mentioned? I'm pretty sure you're talking about Brian Shannon's book.
Hold up.
I got Brian Shannon. My camera might suck ass, but
yeah, that's his Twitter.
Yeah.
The book is he got 2 books actually. First book is technical analysis using multiple time frames. That's the first book. And the second one is maximum trading gains using AVWAP.
Perfect.
So these are the 2 books.
They just literally messaged me, so they should heard you just now.
Yeah.
How much are them books? They expensive?
Yeah. So Dustin, what you did after that to overcome that? Are you still trading futures or you just quit?
No, I'm still trading futures. As a matter of fact, I'm trading futures on an Apex account. So it's kind
the
of
funded
like
account.
Yeah, the funded account. So I got a $50,000 trading account, and I'm still in my 7 days. So I'm still working it.
Be safe, man. Be safe.
Oh yeah, man. After I lost that 400, man, I backed off and just kind of sat there for the day and just watched. I didn't make no trades.
I did that. I did the prop account, and I lost mine, but that's because of fucking earnings. That was like
SPY don't even move that fast. I learned my lesson with stops doing Forex, trading NAS 100 and Canadian, Japanese. That's how I lost like a lot of money. That's the time where I would take my stops off because it would get so close, and I take my stops off. And Forex, that shit flushes. That shit moves too.
Yeah, it moves fast on the NAS 100 on Forex, man. I trade the Forex myself, dude, myself. So yeah, I know.
Yeah, it's no joke.
Crazy too, man. Currency pairs.
Yeah, currency.
Man, like when I started trading futures, I think I started like 2021 with futures. And I realized why they have the PDT rules. That's what made me realize the importance of the PDT rule, why they have it in stock market.
That's why I don't get rid of mine. Everybody keeps telling me to get cash account. I need my training wheels. I'm okay. No,
I'm still on a PD. I'm still on a pattern day trading restriction with Robinhood right now. It won't be released I think until around October.
It's pretty simple, man. Like, okay, this might help out a lot of margin users as well. Hear me out, all right? When you open a trade, don't you know that you don't have any day trades left? I'm 100% sure you do.
And when you open a trade, you don't have any day trades left.
So let's say like you already took like 3 of your day trades, all right, per week. You have 3 day trades per week if you're using margin account. So let's assume you 100% know that you already traded 3 day trades that week. You don't have any day trades left. Now the question is, why the fuck will you open another position when you damn sure know that you can't get out of it if it goes against you?
Yeah. Okay.
I already know, man. It makes plenty of sense, man.
That's why
you take a high probability trade.
It doesn't matter though. Will. Like if you can't, like even high probability trades fail.
You're right, but
If you can't
I
exit
got
on the same day,
I got
then why
stopped out on
open it?
Apple. I know.
I swing, so that's why I'm like kind of I'm playing devil's advocate. But
Mm.
you gotta, you better be damn sure whatever you playing works. That's all I gotta say on
You know,
that.
I get what you're saying, Mario, because mostly everybody use cash accounts, and that's why they get hit, and then they be like, "I got enough buying power, but it's saying I owe such and such money," or that because they got themselves involved in too much of a trade,
I
and
mean,
they balance can't even
worst
cover
advice,
what they
man. Like the
lose.
worst advice you can give to the new traders is like switch to cash account, trade more. Like, why will you need more than 3 day trades per week? What are you doing? You're new. You don't know what you're doing. Why do you need to trade more than 3 times a week? Especially
You
if you're
really,
new.
5 more
you really
contracts.
don't, man. Especially when you're day trading, you don't need no more than 3 trades a day. I mean, really, 2 is enough.
Two's definitely enough. Three is crazy. It got to be like FOME. It got to be a big event where we just keep flushing. That's rare to flush. It's you most likely gonna flush at opening and then probably one more time if that. That's hard. You
Yeah, that's
probably
when I
only
catch
getting one
mine
good
is open.
trade in the day.
Yeah, that's when I catch mine is flushing and opening. Yep, right at open.
Yeah, that's a good. Yeah, that's a good scout.
That's a good scalp. That's what that. It really it works every time, just about.
Yeah, that's how Spence he trades like that.
Anchor.
Off opener.
Yeah.
Yeah, exactly, man. Like, especially if you guys are using margin account, you already lost 3 of your day trades. Stop
Do take
opening
some
new
deals.
positions. You can't close
Yeah,
it. You
yeah, I'm
can't
done.
close it.
I'm done. Yeah, I'm done. I ain't gonna day trade like that anymore. I'm done with it. I want to keep my trades where they're active and just keep it right there on the line.
Yeah,
Actually, before the line, yeah, because I don't really want to hit 2. If I got a good trade in play, man, I'm just gonna let it roll and go in and out.
exactly. That's it. Simple as that. I
Um,
always like when I used to have the smaller account, right? When I started out, like not started out, when I started out, I was a fucking dumbass. Like I was talking about like 1 year into the trading, 1 year into trading. What I did was I didn't change to cash account during the time. I did use 2 of my day trades for day trading, but I always had 1 day trade left because like just in case I open something and if it goes against me, I need to use that 1 day trade to cut my losses. And I learned it the hard way to never, ever, ever, ever open a position if you goddamn sure know that you can't close it if it goes against you on the same day. It's okay. Let me give you an example. It's like playing earnings. The only difference is the earnings, it's more of like someone shooting you in the head. It's gonna go like you're not gonna feel anything until the market opens the next day. But this one is someone like slowly, like putting the knife in your bum.
okay, like
It's gonna hurt and you can't do anything about it because you're just gonna watch it slowly melt away in front of your eyes, but you can't sell it because if you sell it, you can't do and they're gonna restrict your account for 90 days.
yo, that happened to me with Roku.
I'm telling you, man, like I've been there. I've been in
Yo,
this.
Roku was up $10 starting in the morning because they cut people up from work. That shit dropped $10 when I bought it, bro.
I'm telling you, man, if you can't sell it, it's not worth it.
Hate that.
So especially if you're using margin account, just be careful. If you traded 3 times that day, so that week, if you did you made money by trading those 3 times? If no, then why are you doing it again? Like when taking it more risk and you can't sell it on the same day, you can't do any changes to the position. So not worth it. Give it
Well,
some
you're
break.
gonna learn. You're gonna learn day trading real fast with cash accounts. That's what you're gonna do because you're gonna lose until you go. I've done blown up a couple accounts throughout the last 3 years trading, trying to figure that out.
Yep. I mean, like that's the thing, man. Like we all learn it the hard way. And when we say
Yeah.
that this is what we learn, people still do the same mistakes. And I'm pretty sure like they'll get to the stage after like 2, 3 years. Like of constant making mistakes, learning from it, making mistakes, learning from it, making mistakes, learning from it, and so on, right? And that's how like they get better. Some of them get better with experience. Some of them listen and then like get better. It depends on the person, I guess, at the end of the day.
Mm-hmm.
So, Will, this question might be more so for you because I don't use Robinhood as much. Someone asks if you go over the 3 PDT, will you be permanently moved from Robinhood?
Nope.
Nah, not permanently. You just gonna be in. I call it the gulag. You get like, what is
90
it,
days
3 months?
restriction. Yeah, 90 days you can't day trade.
you can't day trade. However, you can still buy options and swing.
Okay.
So that's either gonna make you a really good swing trader if you find yourself in that position, or you gonna learn to be smart and know how to use your day trade and know that okay, I'm at 3. Whatever I got in place, It's up. If it's up, then it's up. If I make money, great. If not, I gotta eat. I gotta wait till next week till the casino open back up.
Right.
Or keep swing trading right, or play. Get a loan, right, and play that loan shark money. That's only 2 options.
There is a way to secure profits, though. I mean, even if you don't have any day trades.
Mm-hmm. Right, you can still keep income coming. You just
You never know. Like, let's say like you used up all the 3 day trades, right? And you were up on a position. Let's say you took SPY 2-day expirations with no way to like cut your losses, no way to like take profits, and you got to hold it to the next day. You can actually secure profits without using any of your day trades or without you triggering the pattern day trading rule.
Oh,
Spreads, right, Will?
yeah.
Yeah, so just convert that call option into a debit spread.
I
You
don't
got
think
like 440
you do
call.
that with Robinhood though.
Yeah.
After already purchasing the call.
Nah, let's say like you bought a 440 call today, all right? So at 440, let's say you bought 440 call and you don't have any day trades left, and SPY goes all the way to 442. So now let's say you bought the 440 call for 1.20, $120, and now the same 440 call at close is worth around $270, let's assume, all right?
Mm-hmm.
And now the 441 call on the same expiration day is gonna be worth almost $180. If $190, you sell that 441 and get that 190 in credit. Now what you do is you got that 440 for $120, and now you're selling that 441 strike and you're getting $190 as credit. You actually secured $70 in profits. No one is going to take that $70 away from you. Even if tomorrow, let's say the SPY just gapped down completely, that $190 is still yours to keep. I mean, you're not securing like $230 or $240 in profit the entirety, but you're still securing half of it by converting it into spreads.
Mm-hmm. That's good.
So this is one way of like securing profits, but if you have no idea what I'm talking about, this is a strategy called debit spreads. Look into it. It might come in handy.
Yeah, that I do know they have like call and debit spreads on Robinhood. I don't really fool them too much, but
yeah, especially like if you don't have any day trades left and if you want to secure it, this is one way of doing it. With puts, you can just convert it into a put debit spreads. When you convert it into a put debit spread, you can still secure profits and you can still hold on to it. If it goes up again the next day, right? Let's say the next day, tomorrow, the market gaps up to 443 or 444, you're still going to be making money because the debit spreads are still going to bring in the money because the markets went up.
That's good to know about debit spreads. I've seen them before on Robinhood, but I've never actually looked into them. But yeah, I've seen them.
Yeah, it's one way of taking advantage of the spreads, like another loophole in options. You can actually like do that to secure profits even if you don't have any day trades left. So the strategy is called debit spreads. There are 2 types: call debit spreads and put debit spreads. So it can sound a bit complicating, but if you look into it, it's one of the most simplest shit you will come across. So just spend like 30 minutes time on that. You will see how easy it is to manage the risk by trading spreads than options.
Awesome.
Put debit spread and call credit spread.
No. Call debit spreads and put debit spreads. You can only do it by debit spreads. If you convert it into a credit spread, then you have to pay the collateral.
So you want the debit?
Just the debit. Call debit and the put debit. Oh, there's another complicated way
because I don't even know about the spread.
I'm looking on Robinhood. That's why I'm kind of like.
Yeah, just go to enable the level 3 from your account. Go to investing.
I see. You said put debit spread, right?
Yep.
I see that, but I don't see a call.
Okay, so let me give you an example. Do you have any open positions right now?
Yeah.
What is it?
I got SQQ. You want the exact?
Yeah, just give me the strike price and expiration. I'll tell you.
All right. So I got SQQQQ 18.5 call that expired 10/13.
All right, hold on. So SQQQ. You said 18.5 calls expiring 13th of October, right?
Yeah,
All right. So now it's going for $112.
yeah.
Okay. So let's say tomorrow SQQQ caps up to 20. So let's say you open it tomorrow. Tomorrow market opens and you got this same call tomorrow and for $112. And the same day SQQQ goes up to $20, but you can't sell it. So what you do is, can you see sell up top? Buy and sell?
Um,
on the October 13th options page, there is buy, sell, call, put up top. Can you see?
yeah, my fault.
Yeah. Click on the sell and then like buy the 19, I mean, sell the 19 call. When you sell the 19 call and if SQQQ goes all the way up to $20, this 19 call will be $1 in the money. And I'm pretty sure it won't be the same at 90 cents. It'll be at somewhere around $140, $150. So when you sell this, you'll be instantly credited with $150.
Yeah.
And you just secured almost $40 to $50 in profit without using up any of your day trades.
So you could sell a contract and buy
and plus you don't need any collateral either because the 18.5 call which you have, that's going to be acting as a collateral. That's going to be acting as a 100 share collateral. So you don't need to put in any collateral to sell this call.
I never really even thought of it. Now I'm like,
Yeah, one way to take advantage of the options, especially if you're under PDT or if you can't sell or anything.
Yeah, I always wanted. I like the combo plays. It's just because I don't do them regularly. Like I don't know.
No, it's just for the worst case scenarios. Worst case scenarios that you want to sell it, but you can't. Especially like you'll see these types of events before CPI or PPI. Especially when people get stuck with a play which they're up massively, and tomorrow CPI is reporting, and the markets can go either way. In that cases, you can convert that thing into spreads and secure some of the profits. And if it goes up, good, you're going to make money. If it goes down, well, you're not going to lose everything. Simple as that.
Is it so? So is it because? So I'm thinking in my head. I could be wrong. PDT is based off of if you buy and sell, right?
Technically, you are technically opening a covered call position. You're opening a new contract by selling it. So it doesn't mean that you're selling the actual position. PDT only gets triggered if you buy and sell the same contract.
Buy and sell. Okay.
So same contract on the same day. So if you buy 18 call and sell the 18 call on the same day, the PDT will be triggered. But you're not selling the 18 call, you're selling the 19 call. That's a totally new contract.
Yeah. No stresses, no reason. Toast champagne to achievements. I think we should dive off the deep end. I'll take you on vacation